You do not want to be investing in the wrong stock. Today we are analyzing the Home Depot versus Lowe's company. We're going to analyze both of them side by side, looking at their historical performance. We're going to jump into their dividend safeties. We're going to take a look at each of their financial metrics to consider which is the best valued stock for the longer term. We're also going to run them both through the insider screening to see whether or not management are buying or selling shares of their own company. And we'll also look towards the institutions of both Home Depot and Lowe's to analyze which one is more traded by these institutions, which ones they prefer. And as always, one of the most important aspects of our comparison, we're going to see which one of these is undervalued. We're going to get to the intrinsic value of both of them. We're going to get to our acceptable buy price, looking at our margin of safety, which one of these, if any, has a larger margin of safety. And we'll look towards Wall Street to see whether or not we can see some long-term upside from their forecast. So let's get into their historical performance. Firstly, let's start up with Home Depot, ticker symbol HD. Over the last year, they are up 13%. Over the last 10 years, up 366%. Now, do bear in mind, this doesn't include those dividends reinvested. And we can see Home Depot's all-time highs at just over $415 at the end of 2021. It is trading towards the upper end of the 52-week high with a yield of 2.32% and a forward P of just under 24. So let's compare this to Lowe's company. Again, positive over the last year, up 6%. Over the last 10 years, slightly better performance than Home Depot, up 382%. We see some more similarities. It is also trading at the upper end of the 52-week range. We see the yield 1.93%, slightly lower than Home Depot, and we see it trading at a much lower forward PE of 17.53. So let's take a look at these two companies. Let's start off with Home Depot with straight away dividend safety score 87. It is safe. Market cap 359 billion. We are looking at a mega cap company. Now Lowe's, it has a slightly higher score, 93, very safe. Market cap 131 billion, so we can see it is smaller than Home Depot, but also a mega cap company. The next part of our analysis, we're going to look at those recessionary metrics. So this is especially important for those that see a recession shortly. So Home Depot, they maintained their dividend during the last recession, 07-09. They had average growth during the period against companies in the S&P 500, and they also outperformed the S&P negative 44 versus the S&P 500's negative 55. We then look towards Lowe's for their recessionary metrics. They increased the dividend during the recession. They had above average growth and they had a near S&P return negative 52%. Now, what's very important with these companies is their dividend growth rate. For Home Depot, we see double-digit increase in February 2023. So we're expecting an increase soon this month. Double digits over the last 5 years. Love to see that. Double digits, 20% over the last 20 years. So after the last 20 years, every single year on average, you would have been increasing that dividend by 20%. Very, very strong. In comparison, you have Lowe's, which only increased it by 4.8% last year in May. However, the last 5 years, 20% on average. And if we're comparing 20 years versus 20 years, Lowe's is stronger with that 25% increase year on year. In terms of valuation then, based on dividend yield theory, and for those that are new to the channel, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. We have a sign here for Home Depot of reasonable valuation, 2.31 versus the 5-year average of 2.41. But bear in mind, with valuation, we don't conclude till the end of the episode. Forward PE, it is sitting slightly higher, 23.9 versus the 5-year average of 21.2. We then take a look at Lowe's company, which, as we can see, a little bit more undervalued than Home Depot based on this, with the yield actually sitting above 1.94 versus 1.88. We also see it pretty much in line with the 5-year average forward PE, 18 versus 17.6. Now we want to take a look at the payout ratio, and for those that are new to the channel, we ignore earnings data. It is susceptible to manipulation by management through accounting. We focus on the free cash flow. My personal favour, below 60%, gives me faith that management can offer those double-digit increases we love to see. The only thing I would note is that while for the majority of the last 10 years Home Depot has been below 60%, it has been increasing with 2023 at 69%, although we know 2024 is expected to come down to 52%, which is positive, and we would like to see, and I think expect, another double-digit increase to their dividend this month. We then compare that with the payout for Lowe's, which as we can see is consistently much lower than Home Depot. 2023 at 37%, 2024 expected to be pretty much the same. So overall, even though we do see the larger increase last year to Home Depot's dividend, for Lowe's we see consistently very, very low. In fact, other than 2020, it has been below 40% every single year. Now let's get into the free cash flow per share. For Home Depot, $4.38 in 2014, and we can see in 2023 nearly 3 times the growth at $11.20. 2024 expected to go even higher, $16. So over the longer term, it does move in the right direction, as we can see, although there are some inconsistencies with some years where that free cash flow per share does seem to decrease. Comparing this now to Lowe's, what we see is a very similar story, $3 in 2014, with around more than just above 3 times growth to $10.70 in 2023. Again, it is expected to increase in 2024, and overall I would say in terms of their growth it is very similar. They are both fairly inconsistent, but over the longer term they do move in the right direction. So let's talk about the sales growth year on year. Now on the channel for these type of companies, we want to see steady moderate growth, 3 to 7% increases year on year. And we can see for the larger part, it is pretty consistent at that. 2021, 2022, during the pandemic where people were at home, they did spend a lot of money renovating. So we do see this large jump in 21 and 22. 2023, it came back down to 4%. Not the worst. It is pretty much within that 3 to 7% we look for. So fairly consistent over the longer period for Home Depot. Comparing that to Lowe's, then we can see, again, a very, very similar story, although we know in the latest year it was a pretty poor performance at 1%. So if you really want to choose a winner over the longer term, the last 10 years, it looks like Home Depot has the better top line growth, but overall they are fairly similar. Now let's talk about the shares outstanding. Now typically we love it when companies do share buybacks. They effectively return excess cash to investor pockets. Home Depot bought back a lot of shares, $1.43 billion in 2014, $1.03 in 2023. So we can see they have bought back around $400 million worth of shares over the last 10 years. Very, very strong. And on top of that, we can see their top line pretty much doubling from around $80 billion in 2014 to $157 billion in 2023. Again, when comparing this to Lowe's, a very similar story, although I would say Lowe's are one of the kings of share buybacks. They have bought back a ton of shares over the last 10 years, going from $1.06 billion in 2014 to $591 million in their latest report. So they have returned a lot of excess cash to investors. And a very similar story to Home Depot. They have nearly doubled their top line over the last 10 years from $53 billion to $97 billion. We also do note though that Lowe's has a smaller top line than Home Depot and as well has a much smaller market cap. Speaking of shares outstanding, share buybacks, we have just literally a few hours ago released our latest free weekly newsletter talking about why share buybacks are important, and we have gone through a lot of companies that have been very aggressive in their approach in buying back shares. Don't miss out, grab a copy completely free, just click on that pinned comment and sign up. We then move on to the ROIC, the return on invested capital. Now this is one of my 7 golden dividend metrics for finding undervalued companies. You can see all 7 of them in one of the free weekly news articles. So I want to see personally above 10%. It gives me faith that management are able to effectively allocate their capital. Home Depot, very, very strong over the last 10 years. The latest year, 45%, absolutely phenomenal. And I do love to see that consistency. Comparing it to Lowe's, now while Lowe's hasn't consistently been very, very high, we do see over the last 2 years absolutely strong, 51%, 49%. And in fact, over the last 10 years, they have been increasing this year on year. So I would say, again, both of these companies are fairly similar. In some of their metrics, one is better than the other, and in other metrics, vice versa. So now let's take a look at their operating and free cash flow margin. With Home Depot, as always, we want to see around 12%. They've pretty much been consistently above that year on year. The last 2 years, very strong, 15%. And we can say the free cash flow margin, again, higher than that minimum 5%. Looking very good year on year. No real worries to the margins on either side. Now, when we compare this to Lowe's company, we can see their margins have struggled over the last 10 years. However, it is nice to note the consistency over the last few years where it has been above that minimum level. And we can see a very similar story on the free cash flow margin. So overall, Home Depot does have the better margin, but very, very marginally better, pun not intended. We then move on to one of the best metrics, which is the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization. This shows us two things. It correlates to the dividend safety as well as balance sheet strength. We want to see a maximum of 3, so these are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.66 for Home Depot in 2023, 1.8 expected in 2024. It still is expected to increase, but it's below that maximum 3 by quite some margin, so no worries there in terms of their balance sheet strength and that very safe dividend score. In comparison then to Lowe's, what we can see is it is significantly higher, 2.29 in 2023, 2.75 expected in 2024, so their balance sheet isn't as strong as Home Depot's, and it is one that I would just say as an investor or potential investor just to keep an eye on, as you don't want it to climb higher and higher, as then it will affect not only that dividend safety but again their balance sheet strength, which will move into other parts of their business. Now, before we jump into the valuation, let's take a quick look at any insider buys. We put both the ticker symbols for Lowe's and Home Depot in the screener. Both buys and sells, a minimum 100 shares over the last 3 months. And what we can see, Home Depot, the senior vice president as well as the vice president of merchandising have sold shares, in fact, at the end of November. Now, what I just want to say about insider selling, it isn't necessarily a bearish signal. Insider sell, whether it's personal or financial reasons. And one thing we can point out here is that since they have sold, the share price has gone up over 16% on one occasion and 18% on another. So again, just some food for thought, but also for full transparency, just to show you the buys as well as the sells. Quickly then, the institutional ownership. So for Home Depot, 68%. We see around 18 billion worth of sales by these institutions over the last 12 months, with a lot more buying, as we can see, the largest buy in Q2. And even in the latest quarter, a lot more buying by these institutions than selling. In comparison, for Lowe's, we see around 72% institutional ownership, so a little bit more, but we see a lot more activity, a lot more selling, and less buying. Now, yes, overall institutions do like Lowe's. They've bought more than they've sold. And likewise, in the most recent quarter, we do exactly see that quite clear. But again, a lot more activity going on with Lowe's, whereas when we look at Home Depot, relatively little activity other than Q2 in 2023. But as always, never copy what the institutions do and always do your own due diligence. So let's jump into the valuations of either company. And as always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So typically on this channel, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's get straight to it. And for Home Depot, we get an intrinsic value of $350. Now, the current price is $362, so we don't really need to explain much other than to say we see the intrinsic value below the current price, so there is 0% margin of safety, and we do see it as overvalued currently. In terms of Wall Street and their expectation over the next 12 months, they in fact see the share price to drop down to $355, so they see Home Depot as overvalued with negative 2% upside over the next 12 months. In comparison, when we take a look at Lowe's company to get to the intrinsic value, we get a value on today's episode of $276. And don't forget, as always, you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. So with Lowe's, we start off with a 10% margin of safety, which we use if we believe it meets 3 criteria. Wide moat, strong financial metrics, and good forward-looking data. At 15%, we see a buy up to 235. At 20%, not quite there yet. So for Lowe's, we see a 15% margin of safety, whereas when we looked at Home Depot, we saw 0%. So in fact, no margin of safety. We in fact saw it's overvalued. In terms of Wall Street, their upside, they see 15% for Lowe's company up to a price of $260 over the next 12 months. So we have two companies that are very, very high in quality. As we run through the metrics, there wasn't a lot to separate them. Even their return over the last 10 years were very similar, although Lowe's was the better return stock over that period. Again, let me know your thoughts in the comments below. Personally, if I had to pick one right now, based on the valuation, based on the margin of safety, Lowe's does look to be a lot better in terms of that value. In terms of comparing them side by side though, my ultimate conclusion would be if you wanted to buy these separately rather than one share of each or an allocation split of 50-50, I would always look to the one which is better valued. As always, if you enjoyed the content, smash that like button, hit that subscribe. If there are any other companies you want us to analyze side by side, drop your thoughts in the comments below. See you on the next one, and for now, bye-bye.